Welcome back to the Scholar Advising Podcast. Today, we're diving into topics from listeners ranging from whether it still makes sense to invest in a vacation rental, to how to handle unequal gifting to kids living in very different housing markets, to what business owners should be thinking about years before a sale. And in the Money and Headlines, we're talking about a recent article from the Wall Street Journal that asks whether money can really buy you a longer life. So let's get into question one.
Is it still worth investing in rental properties or vacation homes given today's market and interest rates?
So the issue right now with a lot of rental purchase, and it's not just rentals, it's investment properties right now in general, is because interest rates are higher, the margins that you're going to have on properties are much, much tighter. We're not getting the same gap in returns from where your return was and where the interest rate you were paying on debt was. Now, a couple of years ago, we were at 0% or essentially 0% financing on things. You could go earn 5-6% on an investment property, pay only 1 or 2% on the interest side of things for the cost. And that gap was fantastic. The issue now is you have the return on these real estate investments being still maybe 6-7%, and the cost of capital to be able to fund that hanging out around 6-7% as well. So because those are now at parity, you're not really earning the gap between there anymore, which has caused a lot of issues on valuation. Now, the way you increase the return on that is either to have more cash flow come in from those real estate investments. And we've seen that go up some with inflation. You're starting to see that become more of a factor. The other is you lower the price. And if you lower the price on these investments, in other words, you go in instead of buying an investment property for $1 million, you buy it for $800,000. Well, that same cash flow that you were getting from the project now converts to a higher return because you're earning $80,000 on $800,000 or 10% as opposed to $80,000 on $1 million at 8%. So those are the only two ways that you can affect the return is going to be either more cash flow come in or a better purchase price. That's why you'll regularly hear people say that real estate returns are earned on the day you buy the property, not when you sell it, because it matters so much when you purchase and what price you purchase it for. So those two things haven't really changed too much. We've started to see real estate prices come down some, but we're just now starting to feel that in a big way. Recent articles and reports out of Florida, you're starting to see a lot of that starting to pull back on pricing in Florida markets, and other states that had a big boom in real estate pricing during COVID are starting to see difficulty in selling homes. Homes are sitting on the market more. We're still not seeing a return to work movement as much as we did see the out of work movement for COVID. So office buildings and office properties still haven't come down in price in a big enough way. And we're having an issue with inflation in that because inflation was so high for a short period of time, rents are still trying to catch up, right? Inflation for rental markets is not the same as inflation for a carton of eggs or a jar of peanut butter. You can't just raise the price. And next month we have all the pricing increase. You can't go and raise somebody's rent every single month. So these are stickier numbers. So it takes a while for them to adjust back up to market rates. So because of all that, we're kind of in this lull in the real estate markets where prices haven't dropped yet enough to get us a higher return. Cash flow hasn't increased yet to get us a higher return, but interest rates sure to go up really fast. So your cost of capital ends up being really high. There's other benefits there too that need to be taken into account, right? There's depreciation advantages. There's a lot to do with passive loss implications there of being able to write some of that off. So there are other tax benefits that you can take into account that can juice the returns a little bit, but it's still not a fantastic environment to really be jumping out and jumping into these things. There's alternatives to jump into real estate. If you're really into it and you want to get into it, there's real estate syndications, there's private REITs. Unfortunately, the returns on these are not fantastic. The further you get away, and this is something I think maybe take a step back and look at. When you look at real estate, the biggest returns that you're going to get are when you're buying in inefficient markets. And what I mean by that is when you look at markets in general, you look at something like the financial markets and you say, I think that I'm going to go buy Apple, Microsoft, NVIDIA today for my account. The odds of you having more knowledge about those companies than the army of analysts up in New York that are covering these companies is really slim. So the odds that you're going to find out when today is a good day to buy it or what the best pricing is for those assets really low. However, when you get into inefficient markets or markets that don't have a lot of coverage like real estate, it is possible for you to find a building in your town that says, that property is actually a good deal and no one's bidding on it, right? So in those scenarios, you can take advantage of inefficient markets and have those higher returns and also have the tax benefits. The further you get away from that inefficient market and you start buying real estate syndications or you start buying publicly traded REITs, you start to correlate more and more to the overall financial markets, which is the opposite thing you're looking for generally in real estate. You're wanting to get the depreciation and tax benefits, and you're wanting to get the diversification from public markets. You don't get those two when you start getting into public REITs. So, bottom line on this one, it's not a blanket no that I wouldn't buy any real estate right now, but it does require you to take a harder look at the numbers to really dig in and say, the margins are going to be tight. So it needs to be a good deal in either the purchase price or the cash flow that you can convert that property to soon after purchase.
We're planning to give each of our kids down payments to buy homes. One lives in California and one's in Tennessee, so the housing markets are really different. How can we handle this in a way that makes sense, especially when it comes to taxes and family dynamics?
Ugh. This is always a this is always a brutal one because it's not just home down payments. It is any type of estate planning and giving. This comes up regularly. Uh, Add to your question, another one that typically comes up in these scenarios is, do I give my kids different accounts based on tax treatments? You have one child who's maybe a high earner and the other one who's not earning as much. Do you give the IRA to the one that's not earning as much because their tax rate's lower than the one who's earning a lot? So this is unfortunately not something that's going to be going away with this question, but it is one that comes up regularly. What most people default to that I've seen is to say, we're going to give X, and that X is going to be used however you want to use it for a down payment. And if you're going to buy a huge house and it's only a 2% down payment, then that's on you. If you're going to buy a smaller house and it's going to be 20%, then that's your choice for it. When it becomes difficult is exactly what seems like you're going through of, I want them both to have a 20% down payment, or I want them both to have the same size home or the same value that you're getting out of as opposed to monetary value. And that is really difficult to do without causing some issues from a family dynamics perspective, because what's going to end up happening is your child in Tennessee is going to look at it and say, this is crazy that you gave $1 million for a down payment on a house in California when I only got 200,000 because the homes are the same size, but it's significantly more expensive in California. That's a harder thing to justify. Now, that is absolutely, you nailed it at the end of the question, the family dynamics issue. That is, as much as I would like to defer and say that's not a financial question, you have to handle the family dynamics there. That is a big factor of it. And it's the word that shows up regularly. It's fair. It's not fair, or what is fair. And fair doesn't always mean equal when we're dealing with these things. And a lot of times it comes down to sitting everyone down and saying, this is what the goal is of the gift. And we want the goal to be, we're going to give X amount of dollars to each of you to use as you want. Or the goal could be, we want both of you to have a home that you can live in and get a good start with a down payment. So we'll determine what that amount is to make that equal. And again, this doesn't go away. I would say those are the easier ways to handle it. The easiest one by far is the blanket, just the same amount of money. You're writing the same check to two people. Now you have to be careful there. There's gift tax implications. One thing that typically comes up is someone says, my main goal is to provide a down payment for a house. And then they go to give the money that year. Maybe they write a check for $150,000, $200,000 and realize they exceeded the gift tax exclusion for the year, which would be $19,000 a person per donor, $38,000 for a couple. That becomes a bigger issue. And it's an issue that can easily be eliminated. And what I mean by that is, if you know that this is a goal that you're going to have, then start gifting now $38,000. So that way you have 4 or 5 years of gifting that's all saved up in a brokerage account or a money market fund or wherever your kids are going to save it. So that way, when they go purchase the house, they have the money already ready to purchase. You don't want to wait until last minute to say, here, I'm going to write you a check for X. And now you have to fill out all the estate documents. And it's actually knocking down your estate limit that you have that's going to be tax free. So thinking about that ahead of time is a big thing. It also gives you time to have that communication with the kids of, we're going to start gifting you $38,000 a year. And this is going to be added into an account. So that way in 3 to 5 years, you have enough money for a down payment. And they start to see that savings aspect as well. There's other ways to equalize that, kind of along these same lines. If you're gifting the same amount every year and one of them needs a larger down payment for a home and you want to make it fair for the other child who doesn't need as much of a down payment, you could always equalize this later in the estate. So you could just reduce the estate for one child who got the bigger down payment by $100,000, $200,000, whatever it is. And that is always a possibility. And is also a clean way to do it. So that way, both needs are being met. Both children are able to get the house in Tennessee and California without having any of the issues of the Tennessee child thinking that they were kind of gypped on a down payment, right? They're going to be able to get that back from an estate perspective, additional money in the estate. It's not the cleanest way to go, but there are ways to think about this if you still want to go and have the same percentage down payment or the same home for both kids in very different states. You're talking about very different amounts of money for a home in Tennessee versus a home in California.
We're about 5 to 7 years away from selling our business and retiring. We're married and co owners and want to make sure we're ready when the time comes. What should we be thinking about now to get ahead of it?
The biggest thing here with your 5 to 7 year timeline is perfect. I wish more people thought about selling their businesses before the year that they want to sell their business, because what normally happens is you run the business and then you get to a point and say, I'm done. And I get a phone call that says, Stephan, I'm ready to sell the business. I don't want to work anymore. And everything's set up financially. The only problem is you can't just go from one day owning the business and then next day selling the business. It's a long process. It's a difficult process for many different reasons, not only on the emotional aspect, but also finding a buyer for the business can be difficult. So we have to start thinking about these things early. You have to start putting yourself in the mind of a buyer. So the things to keep in mind now, you're 5 to 7 years out, which means you have plenty of time to clean up financial statements. Generally, when a potential buyer is going to start looking at your business, they're going to want at least the past 3 years of financial statements to see where things are. So what you don't want in those financial statements are a bunch of weird expenses that you were writing off that may or may not have been personal expenses that you put on the business, and going through and finding out that maybe you accelerated purchases during those years or accelerated income during that time. There's all these different things that you would do, a lot of times for tax purposes, that start to raise a lot of red flags or questions when someone's looking at your financial statements. So great time to go through and have at least those 3 years, get in the habit of having clean financial statements. All of it should be understandable and running as efficient as possible. The value of your business is going to be based on the amount of earnings that your business creates. So in other words, EBITDA, or earnings before interest, taxes, depreciation, amortization. Think of it as net income, usually the bottom line that your business made plus depreciation. So that number is generally going to be multiplied by some sort of multiple. Let's say it's 2 or 3. And that multiple multiplied by earnings is going to be the business. So if that's how we're going to calculate the value of the business, we need to make sure that earnings number is as high as possible. So running an efficient business, running it lean if needed, making sure that all those possible opportunities for revenue are actually coming to fruition. All the possible ways you can cut expenses are being done. So that way you have the highest earnings numbers that'll help with your multiple. So clean financial statements, running well there. The other one that comes up, both of you are in the business, you're co-owners. The big question that's going to arise is, do you have a job or do you have a business? And that shows itself in 2 ways. One is going to be, what are the earnings of the business if you took out a reasonable salary? And many times owners aren't taking out reasonable salaries out of their business earnings. And what that ends up doing is, let's say you have a business that's earning $1 million a year and neither of you are taking out salaries or any compensation. That if I'm looking at your business to buy it, I'm not going to say that you earn $1 million. I'm going to say the earnings is really $1 million minus how much you both would need to be compensated. So I might decide that both of you need to be compensated $150,000 a year for executives of the business. So now I'm going to drop $300,000 off the top, and now your earnings are only $700,000. Where that catches people off guard a lot is they say, well, Stephan, my business makes $200,000 a year or $300,000 a year. And then we dig into it and find out that they haven't been paying themselves anything. So now when you take out a couple $100,000 in earnings, the business is really only making $50,000, $100,000, and you multiply that by earnings, and now the business is worth 100 grand, 200 grand, which is not nothing, but it's usually that number where people come back and say, well, at that point, I'd rather just keep running it, or I'll just shut it down if that's the case. And that's not the spot you want to be in. So the other factor of that, of you all being owners and operators in the business, is not only the salary component, but how much does the business rely on you? The less the business relies on you, the more valuable the business is, both from a financial perspective and from an organization perspective. You want to avoid key person risk. And in this case, you likely have two key people risks, that if you two were not there, would the business be able to run effectively? And if the answer to that question is no, then the value of your business is dropping. So over the next 5 to 7 years, what you need to do is clean up the financial statements and make sure you're paying yourself an appropriate amount of salary, and do everything you can to start removing yourself from the business so that you're no longer an employee of the business, but you're an owner of the business. It's going to be much, much easier to sell at that point, and then start shopping for buyers. It doesn't have to be direct, but the highest valuation you're going to get for your business is going to be strategic buyers. Strategic buyers are going to be a competitor, it could be a supplier, it could be one of your biggest customers, anyone who's going to see more value in your business than someone else off the street. So for instance, this is like the pet food store buying the groomer next door, right? Natural synergies there. It's going to be worth more to that business than anyone else. This is Disney's acquisition of Marvel or Star Wars. Right? Anyone else buying the Star Wars franchise would not have had the value that Disney buying that franchise would have. So you're looking for your Disney to buy your company, right? And really try to find those opportunities for strategic buyers. The other one that I would add in, this is more, and this is a little bit down the road, but starting to think about charitable planning as well. If you are going to do any type of DAFs or any type of charitable giving, you may want to hold off on those until the business sale goes through, because that is 1 year where everyone starts to become charitable. The year of a business sale is when people who are not charitable or haven't thought about it suddenly want to start donating to charity. It's not necessarily a bad thing, but there's some huge tax advantages from that. So we start to see a lot of different issues come up at that time related to charitable giving. And what are you going to do with yourself after you retire? Both of you have been in the business, right? And now you're going to shut it down, sell it. What does the life after retirement look like? What are you going to do? Is that going to be enough money for you to be able to retire? So think about general financial planning during that time. Makes sense as well. All right. And now it's time for our rotating special segment. This week, we're doing money in the headlines. So if you get our emails, you might have seen this in our recent Q2 newsletter. We highlighted a Wall Street Journal article titled "Money Can Buy a Longer Life to a Point." Thought it'd be a good one to unpack here because it touches on a question that comes up a lot. How does wealth actually affect longevity? And what's great about this one for this week is it actually ties back to one of the questions we had on the Tennessee versus California home purchase and what the differences would be there, where you live, and different costs of living. So the results of this paper are pretty interesting. That the study was published in Medical Journal. The top 10% of wealth holders in the United States live about 14 years longer than the bottom 10%, with the top 10%, because I know this is the question you're thinking, the median age is about 86. Right? So if getting up there in the high 80s with a higher level of wealth. But what's interesting is the benefits of wealth are really pronounced earlier on in wealth. So in other words, jumping from $14,000 to, let's say, $20,000 of income may add 10 months onto your life. But when you go to $225,000, you have to jump to $2 million to add that same 10 months. So it starts to flatten out. And that's where the kind of to a point comes from. You have this huge benefit of wealth adding longevity, and then it starts to taper off after a certain point of you can't buy a longer life after around 86, according to the articles here. And what's interesting is how that manifests itself. Like, what are the reasons? And that's what's neat about the article. And it nails a few different items. One is how you handle stress, right? So having your financial house in order leads to less stress, people live longer. The other, which I really found interesting, was just the community wealth factor. So living in a community where the community and neighbors have a higher income level or a higher wealth level generally means better access to healthcare, better access to infrastructure around town, so it's safer, lower proximity to pollution and dangerous environments as well. So it's not just having the money in your bank account, you're living stress-free, and that leads to a longer life. It's all of these added factors that tend to come into play that say you have a higher level of wealth, so you live in a safer area, right? You don't worry about where your next meal is going to come from. In fact, you start worrying about what's in that next meal. So you start focusing on wellness and where the food is coming from and how it's processed or not processed and all of these things. Those are luxuries that you're able to buy with a higher level of wealth, and just the different mindset shift that comes with not having to worry about your finances, which all lead to a healthier lifestyle and a longer life. And that is all we have for this week. Thanks for listening, and until next time. Hey, this is Stephan. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle on a future episode, share with us at scholarfinancialadvising.com/podcast. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only, and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.